Okay, so today we're going to talk about the last of our four derivatives that we were going to focus on in this course, that being the option. So we're going to talk about option markets as well as the options themselves. This is the first of these lectures. We're going to have another one that's going to follow up talking about option strategies. But first we have to understand what it is we're dealing with. So when it comes to types of options, the call and the put are the initial classification we're going to look at. So a call gives you the option to buy, but not the obligation. So if you purchase a call, you can buy, and someone who wrote the call is obligated to sell if you exercise it. Okay, so a call you buy if you want to buy the underlying in the future. A put, it gives you the option to sell it in the future, right? So a call buys and a put is to sell from the perspective of the option buyer. And then European options can be exercised only when it matures, right? So they'll have a date for that option, and a European option will exercise or not exercise only on that date. Okay, an American option can be exercised at any time up to and including that final date, right? And so I know it sounds a little trite, but it's a way to remember it. So, but if an American option is just like a European option, it just has more freedom, right? So it's just kind of just a way to think about that, right? So, so those are going to be the options that we're dealing with. Now, I said we have a call and a put, but someone buys it, someone else is going to have to sell it, right? So what we're going to have then is the position of being long a call. That's when you bought the call, or being short a call. That's the person that sold it. And when we talk about options, we don't necessarily say you sold it as much as we would say you wrote it, because the option did not exist until the person wrote it, right? And so that's when we would say that they wrote it when they're short that call, right? And so you can be long a put or short a put. You can be long a call, short a call. So these are the four positions that we're going to focus on. Now you may recognize this from the handout that I gave you with these charts drawn in. So that's so this may look a little familiar, but I'm going to draw these out for you. So if you see here, this is a long call. So a investor purchased this, and then they have the ability to purchase the stock in the future for $100. That's what the strike price of 100 means. So if you look at the payout, any strike price less than $100, you see this -5. That's because it cost them $5 to begin with, right? And so because of that, we're going to start with this -5. But then once we hit $100, it goes up dollar for dollar because we can purchase the stock for 100 and then we can immediately sell it for some price more than 100. So once this gets up to $105, we're at break even, right? Because the option is now paid for itself. And then anything above $105, we would be making that additional money. Now, the person that wrote this, their payoff is very different. You would flip it, rotate it around. And so they gain $5 for any stock price less than 100. And then once it hits 100, it begins dropping off. And there's no limit to how low this can go. Just like there was no limit to how much you could make being long a call, there's no limit to the loss they could take being short a call, right? But they started out being $5 positive because they wrote that initially for you. Now, being long a put goes the other way. So you would purchase this, in this case, for $7 with a strike price of 70. And then if the stock price falls, you make that additional money up to the limit of, the price could only go to $0, right? This could only go all the way back to 0, in which case you would make $63. So that's the most you could possibly make being long on this put. But the most you would lose is that $7. the person that wrote the put, the short put position, right? They can make the $7 that you potentially could lose, and their losses are actually capped though. They can never lose more than that 63, right? Because if you're making it, then they're losing it. So so that's what you would see in that payout. So just thinking about the long call and then the short call, the long put and the short put, anytime you're seeing these types of shapes, this is kind of an exercise for yourself, but which of this is like a long call, a short call, a long put, a short put, and just being able to recognize these patterns will help when we get to the option strategy, because we're going to combine these to make more interesting shapes. So it's almost like a little game where you're connecting the little pieces together to make the payoff structure that you want. Now, as far as the options themselves, they can be written against a variety of underlying assets. Stocks are the ones that we're going to talk about a lot, just because it's interesting to talk about stocks, and also having those. Well, this is going to be the most common, but you can have options against ETFs, currencies, indices, futures. In fact, a lot of people. In fact, there's lots of combinations of various derivatives. So whenever we talk about these exchange traded options, since it's not exactly the same as a stock, it may look a bit different, but it'll have the expiration date. It's still going to have a strike price for that ETF. It can still be European or American. It can still be a call or a put, which is the class of the option. Anytime you hear class, they're saying calls or puts. Also, we were talking about that strike price. If the current price is the same as the strike price, then we say that it's at the money, right? And then as those differ, it can either be in the money or out of the money, and whether it's in or out depends on if it's above or below and a call or a put, right? Because a call, if I can buy it, if the strike price is $50 and it's currently in the market for $40, right, then I would say that's out of the money, because I could buy it on the market for 40. So why am I buying the right to buy it in the future for 50? Right? It must be because that's a really, really cheap option, and I think the option or the stock price may shoot up. But if it's that same $40 and there's a $35 strike price, then that one we would say is in the money, because it already has $5 of that intrinsic value, right? So it's already in the money. Okay. And then some other terminology, option class, we already mentioned that, the call or put. Option series will be all of the options that are going to expire on a particular date, like the month of April, they're going to expire. They all have the same strike price of $35, right? So regardless of who all is writing it, once that option is written and out there, it's got a set price. The strike price, it's got a set delivery date, or it's an American option, so all those would be grouped, but it has all those same properties. So we would just consider that to be a series. I don't care if the underlying person that wrote the initial option was, an investment bank, or if it was just a person with their own account. It's out there. So that's what the series is. Intrinsic value is that in the money amount. Right. And so it's got that intrinsic value because that stock is worth that much. And then the time value would be the rest of the value of that option. Right. And so if it's out of the money, all it has is time value. There's no intrinsic value. Right. But the intrinsic value plus the time value will give you what the value is in the market. Right. Because you're paying for both of those. Couple of other details just to talk a little bit about is what happens if there's a dividend or a stock split. It's okay. If you see there, I show you how we change the strike price and how we change the number of shares. And we're just trying to level it out, right? If they had a 2-for-1 stock split, then obviously the price of the stock is going to be cut, right? Because you've done this before in like earlier finance classes, so the stock price is going to fall because there's going to be twice as many shares. And And so we just adjust all of our stuff the same way. And then if they were to pay a stock dividend, then it would look a lot like a stock split, and we're able to handle those prices and the number of shares within the contract, the same way, right? And so what it's like, so as far as the option is concerned, we modify it so that it looks like there was never a stock split as far as your actions. So, but all that will happen behind the scenes. But sometimes you'll see that in the market where it's got this weird pricing thing or a weird number of shares. It just means there was like some sort of stock split or something like that. So, and just as an exercise, here's work through this kind of stock split. Here's a call option, 100 shares at $20 per share. So if you did a 2-for-1 or a 5%, just you take that as like a personal exercise that you can work to understand just how we just make sure that it's going to look the same. And then once this is all over, new ones will be issued for later months, and it won't matter in those. Okay. Most of these markets use a market maker. And so market makers, they act almost as like their own clearinghouse. So they come in and they'll give quotes. And then what we do is we look for the best quotes so that they don't know if we're buying or selling. They don't know really much about us, so that we can just get these prices and we can go from maker to maker to get the one best price for us. Whenever you're selling options, so these are the people that write the option. So if you buy an option, you can buy it. I mean, they don't really worry. But since you have an obligation when you write that option, they're going to require you to keep a margin. And so this is similar to like how you have to keep a margin if you do short sales, right? So, but these are just some rules to look at when you're considering going into these positions. Okay, and then warrants are a little bit different. It is an option, but it's going to be issued oftentimes by the corporation themselves. And what they'll do is they'll sell that warrant initially with this stock price, and normally with a company, I think I have a slide. There we go. The company is actually issuing out treasury stock based on that. So it's a way of trying to get investor interest, right? You can sell these options to initially raise the cash, and then if they exercise it later, it just means, hey, our company is doing well and they want to invest, so why wouldn't we want to sell them stock? So so you'll see that. And also stock gets used in employee stock options. And so an employee stock option is just compensation. So when you were doing accounting, you're probably learning how we expense out the cost of labor, right? When we have to compensate our employees, we just expense that out, and we would also expense out this option. And normally what happens is they will issue it at the money. So if it's the current stock price is $35, then the employee stock options are at $35, but the employee stands to benefit a lot if they can get that stock price higher, right? And so the idea with these employee stock options is it encourages employees to work harder because they're invested literally in the company. And also it keeps employee morale up, because as this company grows, all the employees themselves are also benefiting from that. So if you hear stories about, the little old grandma who worked at Walmart for a long time, and it turns out she's a millionaire and that kind of thing, is normally because of these types of stock options that were going on behind the scenes. Another way that you'll see options is they'll be embedded within a bond. And so a convertible bond, for instance, is a bond that can be converted into stock, right? So I'm a debt holder and I can turn myself into an equity holder. And you can imagine if you had a company that was potentially going to take off, that you could see where an investor might say, hey, I'll take the guaranteed right now, but I'm willing to pay a little extra, right, for this convertibility that I can turn this into equity, right? And so, that's all. When we price those particular bonds, we first price the bond, and then we have to also price that embedded option to come up with the market price for the bond. So it's just a neat little way that we'll also see options show up, even though it's outside of that normal call put option market, right? So now I'm gonna go into a bit more of the math of the pricing. So as we do that, this is what the notation is going to look like. So if you see here, a lowercase c and a lowercase p is for a European call and a European put. And we use a capital C and a capital P for an American call or an American put, right? So C is always call, P is always put, and then lowercase or uppercase is to let us know if it can be exercised before the expiration, okay? And then we use a capital S for stock price, and then we have a subscript that we use for what the time is. So S sub 0 is today, time 0. And then S sub T is normally what the maturity is going to be. If we're using a capital T, it's the maturity. If there's a lowercase t, it's some time period before expiration, right, or equal to. So sometimes you'll see a lowercase t. That's when we're dealing specifically with American options, because they have some special rules in between. Okay, so if capital S is the stock price, we have to use another level for strike price, right? It begins with S also. So we use K for strike price, right? So capital S is the stock price, capital K is the strike price. T is the life of the option. It's the same T here, right? That's when we use that sub T. Capital D is for dividends. Again, dividends will matter because it changes the nature of those stocks. And also whether or not you should exercise American options will also depend on the dividends. Sigma, if you remember in statistics, we used like a mu for the mean and sigma for the standard deviation, right? And so you can think of this as the standard deviation of the stock price around whatever the current price is, right? So you can think of how much the stock is jumping up and down. So the more volatile the stock, the more likely it is that it could go to more extreme values, where if you have a stock that doesn't move very much, it's the price probably won't move very much in the future, right? And so if you think about stocks that are very in the money or out of the money, right? So they're very far away from the current price, the volatility of the stock will matter, right? And then we use lowercase r for the risk-free rate. And we always use continuous compounding, right? We've gone over that before. So if you think about the relationships here, this is just a little grid. And again, the nice part about the video is you can always pause it, but you can just see, okay, as the stock price goes up, the value of calls goes up, the values of puts go down, right? As the strike price goes up, the value of puts will go up, the value of calls will go down, right? So just these relationships. As far as time, the reason these are question marks is because we can't exercise these early, right? These are the European ones, right? And so we don't really know, all right, because it could go up or it could go down. But since with the American options, we can exercise it early, we can exercise it if it goes up and we just ignore if it goes down, or for the put, I guess it would be down instead of up. But we could always exercise it when it's favorable and then just choose not to if it's unfavorable, right? And so that's why it gives additional value here. And we can't really say what it's doing for the European ones because they can only exercise at that, the final maturity. So, but yeah, so that's just a way of thinking about that. And as far as the American versus European options, American options are always going to be worth at least as much as a European option, right? And the reason we're saying, at least the reason it could be worth more is because you have that additional ability to exercise early, right? And so the more you can do, the more option you have, the more expensive it's going to be for you as a general rule, right? So so that's why we would say we would expect these American options to be greater than or equal to the corresponding European option, right? So if everything else is the same, right? And then this is just something to think about. So we're gonna we have a European call, right, for 3 units, dollars, euro, whatever it is. The time is maybe 1 year, you know, the T equals 1. The strike price is 18, but the current stock price is 20, right? So it's currently $20. The strike price is 18, but the interest rate is 10%, right? The risk-free rate is 10%. So instead of putting in 20 and just letting it sit there, right? Because it'll be in the stock, right? No dividends being paid, right? But I could wait and just let the money grow at 10% and then purchase it for $18 in the future if I pay $3 for the call. Right? Hopefully that makes sense. So I would end up paying $21 total for this $20, you know, stock, but I would be able to invest at 10% otherwise. So you know, is this an arbitrage opportunity? Is there one of these that's better than the other? This would be the lower bound for what that option looks like, right? So the current strike price or current stock price minus the strike discounted back at that 10%. Right. And so that's what we would be looking at with a no dividend. And then we can do the same type of exercise looking at this put. And I'm sorry, I missed my hard return there. But yeah, I'm sorry, this time is half a year, right? And so when we're looking at a put option, we have the same type of calculation, only instead of it being the current price minus this future strike, because it's a put, it's the future strike minus the current stock price. Okay, so the reason we're talking about these you know, the bounds for these is because what we're looking at is we would expect the market to try to get rid of any mispricing that occurred. And because of that, we have what we call this put call parity, where these prices will have to converge, right? So we're looking at 2 portfolios, a call on a stock plus some zero coupon bond that pays that strike price, right, at time T. Right? So I have the call, and then I got the zero coupon bond that would pay for buying that stock that's underlying it, right? Or having a put in the stock, right? So I can buy a put so I can sell my stock to you at some particular price. I don't have to, right, if the stock were to go up, but I could. Okay, and so the call option itself is going to be the difference between whatever the price is and whatever that strike price that I can purchase it at, right? That would be the value of the call option itself. If the strike price is less than this, right, I don't have to exercise. So instead of having some negative value, the lowest it can go is 0, right? The zero coupon bond is going to pay us K, right? That's by definition of that bond, right? And so if you add these totals together, you're either going to get S sub T if it's bigger than K, or you get K, right? So you get either one, right? Now, what about the put, right? Well, if you have S sub T is less than K, right, then you get K minus ST, right? If the strike is higher than K, then you just don't let it exercise, right? So it's just 0, right? You don't have to exercise it, okay? The stock price, right? You own a share, so you're going to have whatever S sub T is. And so if you add those up, you notice that again, you get S sub T if it's greater than K, or you get K if it's greater than S sub T. Okay. And since they're both going to be worth that same amount, right? That means it must be worth the same amount today. So the value of the call plus the present value of K, right? Because that's what this is giving you, right? Because you're going to discount it at the risk-free rate times T, right? So you're going to discount the current or the future strike price. You're going to discount that back to the current day, right? Or have a put plus the underlying stock, right? And so this result is really powerful for us because it helps us with our markets and making them complete. Okay. Now there is some chance that an American option can be exercised early, right? And so since you can do that, right, you always have to expect that it could happen. And this causes people that write American options, right? Those people that are short the option, right? The people that write this option, they get put in a position where sometimes they have to hold assets out just in case they were to get some sort of squeeze. So they have to keep this available. So that's just something to kind of keep out there. But if the stock does not pay dividends, and you have a call on it, then you should just treat it like a European option because you're not getting any periodic cash flows from it. And so you should exercise it as if it were a European option, but you could always, if you wanted to, you have the option, but mathematically you should not. And this is just an example, so I give you a current stock price, right, of 100. We're going to wait 3 months, a quarter of a year. Okay. And then I have the strike price of 60. Right. So should I exercise immediately? Right. So if I were to exercise it, right, I got this $40 difference in what the current price is and what my price would be. Right. So it's got that $40 value. And so what, if you want to hold the stock for this next 3 months, what could you do here? Right. What would make the most sense? And then if you do not feel that the stock would be worth holding for another 3 months, what should you do? Right. So this is just something to think about, like I said, it's pretty extreme because like this $40 value, but just think about it because you may want to hold the stock. You may think, hey, actually, I think that it could go up even higher. I think it might be $150 in 3 months, or something like that. So anyway, and so the reasons you wouldn't exercise the call early if you had no dividends, remember this is an American call, you're not losing anything, so it's just having the option gives you more options, right? And so you're just better off holding it. And then if the stock prices fall, you can always exercise it, so that's why we would not normally exercise that. And so we'd said that, remember, the American call will be greater than or equal to the European call when there's these no dividends. So you can see sort of a bound, right? So whatever the current stock price is, will act as a bound. And then this value here of, what the value of this call should be based on the discounting of the strike price. And so our prices will always fall in that region. It's the shape of this is going to vary. We won't get into too much of, the exact nature of that, but just understand that they'll fall within that region because based on the volatility and the time remaining and things like that. So, and so here's a way of thinking about should you exercise a put option, because we talked about calls specifically. Now puts are a little bit different. There's a lower bound on how low stocks can go, so that's something maybe to think about. But here's basically the same situation, right? The stock price is 60 and the strike's 100, but it's a put, right? So it's going the other way. But But think about that, because you have, you know, limits on puts. Remember when we were drawing out what those pay structures looked like. And in fact, here's the bounds for European versus American puts. And if you notice here, you know, it's a strike price and a present value of the strike price. Now, the reason that's different is this American one could be exercised, right? And so capital P is going to be greater than or equal to little p, right? Only if you're discounting it at 0 here, right? If R is equal to 0, right, then this whole term goes to 1, and so it just ends up being K, and these would be equal, you know. But it's just to give you, you know, so you can see. Imagine if you overlaid this on top of this one, right? You would end up with this, you know, higher. But you would also have some overlap regions, so they could be equal in certain situations. Right. And so when we add in that piece of dividends, because remember we have the possibility that dividends could be paid. And so if you hold the stock, you're going to receive this dividend. And so, you know, you have to make that up when you're exchanging this in the future. So you're seeing this dividend show up in there, and it just gets priced into the call or the put, right? So it's a similar exercise, and in fact, we can extend our call put call parity based on when we have these dividends, right? So if we don't have dividends, we have our standard put call parity, and then when we start adding in these dividends, then it still holds. We just have to make sure we're including that, you know, for it to hold. So, but yeah, that's an introduction to options, both the options markets and then the options themselves. Our next lecture is going to be on strategies around these options. So I'll have that one up for you soon. And I just look forward to answer your questions. So please email me if you have any. Thank you.